Boom, 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 boom. Hit refresh. There we go. Oops, that's supposed to have been 66. Well, I'll change that later. Copy link address. There we go. Copy. Boom, boom. This out. All right. And then come here. Boom. And then put at CAS. Nope, that don't work. I'll have to get that later. But what I'm going to do is just copy my last one, right? Give me 1 second, y'all. Let me grab my data from one of my posts for the Cash Lane crew. Which, damn. Oh, I didn't even hit them up last time. Let me go further up. I'm sure I did it someplace. 1 moment, y'all. Give me 1 moment. Gotta go back in time. And I could speed this up by just doing a search. But I feel like by the time I do that, it's gonna be like the next one to show up where I did it. And I just keep scrolling. My apologies. I'm going to give it 1 more second to see if I find it. And this is it. Did I do it here? Yes, I did. See? Told you right when I would decide to change over and do it, it would be right there. So let me edit this and then just change that out to this. Boom. All right. Yo. What up, everybody? Hope everyone is doing well. We're gonna get into this right now. I'm not gonna hold this up, man. We've got to get into the BS command. Yeah, no, man. I just figured scroll. All right, so y'all know how I am, man. I take my time and I try to do as much research as I can, because I'm dealing with company assets as well. So it's not even like, oh, I'm just playing with my own bank. Like, no, I'm playing with business assets, or I'm strategizing business assets, right? And that's important. Now, part of that is I've been focused on Bitcoin and the halving cycle, and that's just how it's played. So if we go back to the charts, right, and let me close out some of these windows because I don't want those resources held up. Let's go here. If we go to the charts, right, and we go on the weekly. Now, what I've been doing, taking the past, going back in time for the halving cycle of 2017, we know we've mapped out how these dips are cyclical, and you see the orange did the same dip here. We had the same September dip there. So I called the pump there. So I figured, all right, it's playing like 2017. Transformer came in and kicked my ass, right? Literally, I have a pump here, and literally there's a pump there, right? That's supposed to happen. But again, we're in the world of Transformer. Optima Prime, whatever the hell they want to call this thing. We just went from Delta to Optimus Prime, right? So since we got Transformers changed not only how I got to think about whether I had to start thinking about where is disposable cash. And why I had to begin thinking about that is I remember 2008, y'all. I remember 2007 before 2008. right? I remember Second Life. I remember how I was making money in Second Life. And then 2008, 2009, I watched it dry up fast. Now, why did it dry up? And this is a education on infrastructure, right? The infrastructure of being in Second Life meant you had a desktop computer. You didn't have mobile phones. That was BlackBerry days. So you had a desktop computer. You had a video card in that thing. And then of course you need, because you're on the internet, you couldn't just use regular internet. You're streaming data, chat, audio, back and forth, video, back and forth. You needed broadband. So you needed to have a broadband connection to really use Second Life. Now, of course, something like Second Life or virtual worlds now can be done on a phone, and that phone is a mobile device, and you can live off your mobile device or mobile internet service now, just the way things are. But it wasn't like that. You had to put way too much money to maintain the internet, the electricity you're spending, and the time that you're spending there. Well, you need a job, right? So that was the transition. That was what made it so hard. Now, Bitcoin comes along 2008, 2010. I'm thinking it's bullshit. And it's supposed to do its job of hedging against the economy. But the economy has traders in it that are on both sides of this equation. So what I've been doing, and if you go into the Discord, link in the description, let me maximize this real fast. What I've been doing is, y'all can see, I've been talking about and I've been linking to, and Sirius actually put this one out, put the chat for up only. I'm looking at all these things, and I started looking at the economy, right? Started putting in things about the economy, Evergrand Crisis. Why am I thinking about Evergrand? I'm thinking about Evergrand because Evergrand has Chinese debt. Then we find out that what? Tether is from where? Tether was from a Chinese exchange. Binance uses Tether, as well as Binance, not Binance, excuse me, Bitfinex use Tether. So these might be tied to Chinese real estate. There's 30 billion in Chinese debt held by Evergrande and in contracts, and there's 30 billion in external paper held by Tether. So could there be a correlation to that paper being tied? Potentially. And I believe the halvening cycle, which I'm going to go back in time for you real fast so we can do this together. So that way you can see it the way I see it, right? We're going to go on the week, and I'm going to scroll out. And I want you to see what happened, certain portions, right? So look, as we're going through the halvening of this 2017, we had that dip, then we had a run up, right? Then we had this hyperbolic thing happen where we went all the way up here. This was December. This is why I kept telling you, for last week of November to the first week of December, I would be out. Then December 17th, or the second week of December, we have a significant brow. And then it trickles all the way down to February, really down to March, April, which is what? Tax season. So where are we staying? All the way through June, we basically are on this flight path down to the bottom. So this December, January dip is not insignificant. Why is this not insignificant? This is not a one-time thing. If you see this red arrow, that is a January dip. Now I want to just pull up all the red arrows we got. Then I want to go back in time, forward in time, and keep showing you these red arrows. This is not a game. Now, we did have a pump here in this one red arrow. Why? Look at what's getting ready to happen. A halvening cycle. So that kind of changes things sometimes, because right before a halvening cycle, you may get a significant pump sometimes. You might get some flags that pop up because a halvening cycle is coming. But for the most part, these dips are systemic. When they're not systemic, there's something else going on, right? So if we go up, halvening cycle, this time around, we have it after the halvening cycle, but you see we still got that significant dip that happened in January, but we also got a pump in February, which is weird, but we are in a halvening cycle. So no, not really, but it came back down, right? Then it did, and this is during that June China FUD, Elon Musk FUD, all this pulled the market back down here. I told you this was my buy zone and this is where I was buying. Well, look where we are right now. Well, I can be an idiot or I can be smart. Since we bought down here, we sell up here, we're at a profit. If I wait for it to come back down here and then it happens to come back down here, which I'll show you why it might end up doing that, then I've lost from this zone all the way down to this zone to come down to potentially the next purple, which might be this zone. So I'm going to show you that in a through my Discord posts, right? Let's go back to Discord. So as we scroll down, I talk about the defaults there. We're talking about the growth estimates of companies, why DocuSign or certain companies are failing now. I say that, look, the contracts are getting ready to expire December 30th. Then the last dip is December 27th. We already have transformer crash. This pump is supposed to happen next week, but I don't know if I want to wait for it. I don't think I want to wait for it. I don't think it actually... Oh, no, actually, that was this next week. Hold on. We're going to keep going. Hold on. So then I show you systemically January dips, the red arrows. Yeah, this one actually changed this because I actually found that this was off on the weeklies and this dip actually did happen. So we keep going, right? November dips. Then I said November 2018. Afterwards, we had a dip. So after this crash of 2017, 2018, we had this crash in January, dips down, keeps dipping. And then around November, we dip down, right around where we were June of 2017. So it dips down into that zone, in that purple November dip. Purple November dip. So that's why I think that if it plays the same way, we'll end up getting that same thing. So then 2024 is the next halvening cycle. So that's basically the next run up, won't be until 2024. Google exec saying they're not going to raise your rates, their pay to other people as far as interest rate. They're not going to pay you according to inflation. So if Google's not paying, Google's going to set the market tone for other companies saying, we're not going to pay you more money because there's inflation, because they understand inflation is going to be, I'm not going to say transitory, but we're going to potentially head into deflationary situations. Then, of course, digital is, of course, taking over with a lot of asset classes. Consumer prices have risen to 6.8% in November. So they can't tell us that we're not spending more money because we are. And they can't tell us that we're not having problems financially because we are. And they can't tell us that things are going to get better because they won't. Why? Even something that was fit for the last depression, which was pizza, came in the last depression. Chinese food came in the last depression. A lot of these, the stuff that you could get on a cart, the cart and meal vendors, that was all during the depression, right? So went from being able to get a 99-cent slice to now it's $1.50 slice, right? Or it's going to be even more than that because, hell, I don't even know where you can get $1 pizza. Coinbase is going to be doing interest elsewhere except for the United States. So again, the United States is going to be behind the 8 ball in financial transactions on an international level. And then I said there was a BTC drop alert that we're about to break a major support line, which is the purples. and we're about to break under the 200-day moving average, which I'm going to show you in a minute. And then I showed where my buy zones were, where we currently are, where we were currently buying, and whether or not I should go ahead and get out. And then I showed where potentially we could bounce to the next support purple line, which is around the 19,000 to 20,000 support. So we would, between this line and this line, we're looking about $8,000 of potential downside. So if I see that, I have to make some decisions. So let me, and then I showed, of course, the fact that I put that on Twitter. Somebody who called the 2017 price crash is saying that there's pretty much, we're going to look at another one. China, the way that they're handling products, Amazon, they're getting hammered. So this is a supply chain thing on another level, right? So, you know what I told you about real estate in China? And I'm going to show you some stuff right now. Tofu, drag projects, right? And let's go to, hold on, let's go to YouTube and then do it here, right? So like we talked about with what's going on in China with buildings actually falling, the quality of the buildings not being good. This is all real estate that is they spent money on. And imagine you put money in an apartment building, and the apartment building you want to put for rent, but then you see how that's flaking, right? So let me open this up and I'll turn off sound so you can see what I'm talking about, right? You're looking at buildings falling down. This is buildings that are supposed to be for rent. I mean, look at that. This is the quality of these. This is investments, y'all. Like, I can't say this enough. This is investments. This is investment property. Streets where stores are supposed to be making money, sinkholes, buildings falling down. Like, when we're talking about the fact that all these people have been saying, oh, we're investing in China, China's growth, China's growth, China's growth. They're talking about China's real estate growth because China was not allowed to invest in the stock market. Real estate makes up 70% of the assets they hold. And this is what those assets are built like. So what do you consider happening? We think, like, they say, oh, well, this is not a Lehman's event. Charlie Munger, China, right? Charlie Munger he's invested in China. Oh, China's smarter than all of us. October, China's betting big in China. In October 2021, in big China. It's all that money, and all they're going to end up doing is destroying this, blowing it up. And the product, the quality of this stuff isn't even that good. This is shoddy material. So they took the money, they built, look at the bricks breaking. This is what we're dealing with when we're talking about bad investments. This is a steel girder pipe just snapped in two. Bang. He breaks it. It's like that. This is what's going into buildings. So that's what I mean when I said we have a roller coaster getting ready to happen. If Tether is even remotely holding on to any Chinese real estate assets as paper, saying that it's tied to, that's how they're pegging their stuff together. Right? So I'm told y'all I've been starting to look at new charts. I have now have this Lux indicator that, yes, it's telling me there's a buy signal, true, but that's on the 2 hour, right? If you look at the 6 hour, you can see we're a strong sell signal. If I'm looking at the RSI, we are above in the RSI, we are above. But if I look at the daily, right, we've been in the negative and have been holding in the negative. We're in the negative on the MACD. When you cross red, look, when you cross into the red on the MACD, boom, immediately, look what happens. I'm going to move this down some. Hold on, let me scrunch this down. Scrunch that down. Let me move this whole thing down. And then on this side, I'll have to do the same thing. Okay. So now, look, when we cross the MACD right here, look what happened immediately. Right here is the Willie. Here's the MACD. Excuse me. Here's the MACD where we cross into the red. Boom. Right here. Cross into red. Right in this zone. We're in red. We cross here on the Willie as well. And and then we cross right here. All of this, these three together give you a power sell formation, right? Well, look, we're still in the red here, not crossed. We're peaking. Yeah, we're peaking in some green here. But look, we're still on the volatility index. We're under, like we were overbought here, so we sold off. And now we're undersold. So yeah, we could come back up. But again, remember, this is the end of the halvening cycle. So while all these other indicators will make me feel like, yeah, we can do it, the hopium, yeah, we can do it, I'm going to now go into the financials. And what I've been learning in financials and why I've been silent for the last few weeks is because I've been learning some of these economic structures. So let me open up my other window. Here we go. So this is why I'm out of the markets till spring. Let's start with the CPI, the Consumer Price Index for all urban consumers. So basically, city people, right? So I want you to see something. This is how much things are costing. And you can kind of see, where it dips when we have some recessions, the shaded areas are recessions. You can see things dip in a recession. And we had a little dip here in that little 2020 dip right there. But just look, we've just been on this tangent of how things are costing. So everything is costing us more money. Plain and simple. They can't lie about it. So I wanted to look also at car loans. Why am I looking at car loans? I worked at the bank. I worked at Citibank Private Bank, so I understand assets. And one of the reasons I left the bank in 2004 was because they had started tightening up after September 11th. So Citibank had multiple locations throughout Manhattan. Then after 2011, under the guise that, because of what happened at the World Trade Center, we want to, consolidate. No, I started noticing they were letting people go. And they were letting people go that worked, they were good, but they may not have been able to keep up with the transition. We were transitioning from web design company internally in the bank. We were a web design company. We were transitioning over to web development, content management systems. So you didn't need as many designers since you only designed once a quarter, maybe, right? And you're using templates, and then basically you're becoming a content company. So everything in the 2008, 2007 that we dealt with was because of subprime mortgages. Okay, so that was basically anybody who could get a mortgage was getting a mortgage because rates were so low. Then all of a sudden, when they've got to flip or raise interest rates, those people were now underwater in their homes, could not afford those bills anymore. Collapsamundo. That's it. So why am I looking? And then what they did was those loans for those homes were tied to derivatives and were put on the market at AAA, which means it was like there's no risk. But there was risk. They were using mathematical, funny, magic money, magic equations to make these crappy assets look like grade A. So basically, imagine if somebody took like yak meat and then said that we do some magic stuff with this and it's grade A beef. It didn't change the fact that it's yak meat. It just changed the perspective. They changed and said, oh, we package all this meat together, but some of it's crappy, some of it's good. You might have some beef, but there's more good beef than there is yak meat. But it doesn't matter that there's yak meat mixed into the beef. It's ground beef. It's all mixed together. It doesn't matter. There's still yak meat in there. That is exactly what's going on with our real estate market. There's a bunch of crappy stuff in there But these rates, they all look good. Everybody's good. Okay, what's happening now? This is car loans. So car loans, the interest on car loans are dropping. So now what happens when the rates of car loans? Now it's easier to get a car loan. So what are they doing now with car loans? They tied them to derivatives, y'all. Magic math is making shitty loans look good. So let's go to hedge funds. Proof positive we have issues. Why? I want y'all to see something. This is hedge funds leverage loans asset level. Now, I need to look this up more, but I'm just going to go off what it tells me, what it makes me feel. Like, these are the leverage positions, leverage loans, asset levels of hedge funds. These are what they're leveraged to the gills with, right? In financial accounts, the source of a series of strange numbers, blah, 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 blah. All right, so it really doesn't give you any info. You have to, but for me, I just think that this means that these are the leverage loans. These are how many loans are out here leveraged. And as you can see, right after we got to 2012, we all of a sudden had this spike up 2013. So this is all the leverage levels for what's happened after the 2000, something happened where we now have this new asset class that was created. Now, from there, I want you to see what's happened. It's just spiraled up. Okay? Total consumer credit owned and securitized. This is credit that has been securitized from consumers. You see, we dipped a little, but then we dipped a little, we dipped a little, and we've just been on a run up. Now, why am I showing you all of this? The importance is that you have to see the fact that we are at a point where more people have more debt on their books than they have actual assets in their books. Massive U.S. debts could trap Powell as the Fed is fighting inflation. Corporate debt has surged to $1.3 trillion. Corporate debt has surged. Not just private consumer debt, but corporate debt has surged. These low interest rates are keeping them up. So what I did was I just did a search on Fed and I grabbed some news on what's going on that the Fed has to deal with. Stubborn high inflation puts heat on Biden and the Fed. They can't inflation. Let's see. Consumer price index 6.8%. So again, it's showing you exactly what we're talking. It hasn't run this hot since 1982. So they're telling you, go back to 1982 and start looking at the things that happened back then. Right? Now, what's also happening? Boom. Cracks start to appear in the NASDAQ tech stocks as Fed meeting looms. Percent. But Elon Musk has been selling his stocks. I've been selling stocks like, nah, I'm not playing. Why? I'm going to tell you why I'm selling stocks. I'm going to tell you why I'm getting out of crypto, because crypto is tied to stock. And this is the biggest bellwether, y'all. This right here is when you know it's time to get out the market. Cramer says stay invested. Whenever the Fed hikes rates, history shows stocks can still rally. Let me show you something. And I'm going to do this on the fly, just so you can see that I just do this on the fly. Jim Cramer, Lehman Brothers. News. Stay. hold on. Let me go back. There we go. Let me do this one because this is somebody. This week marks the 10-year anniversary of Lehman Brothers collapse, right? Bear Stearns is fine. Do not take your money out. March 11th, Mad Money host told everybody to stay in it. Peter writes, should I be worried about Bear Stearns in the terms of liquidity and get my money out of there? No, no, no. Bear Stearns is fine. Do not take your money out. If there's one takeaway, Bear Stearns is not in trouble. I mean, if anything, they're more likely to be taken over. Don't move your money from Bear. That's just being silly. Don't be silly. Okay? So when Jim Cramer tells you to do something, you should immediately do the opposite of whatever the hell he says. If he tells you to stay in this market, get the hell out of this market. Don't listen to that idiot. Why? He's telling you that Fed rates hikes in history show that stocks rally. When? 1929? When the Federal Reserve rate increase had unintended consequences? Oh, because it was attached to the gold standard, like we're attached to the US dollar oil standard that we don't control? Oh, okay. The Fed's actions forced foreign central banks. So now let's go through what I'm about to show you. I don't want you to look at 1929 and say that this one action did this thing and it trickled down to all these other things. I want you to just see these actions happened, period. And then ask yourself, are these actions happening or will be happening or currently already happened in our timeline right now? Right? Which is what? The Fed actions force foreign central banks to raise their own interest rates. So, are other countries going to start tightening on their interest rates? Yes, they are. They're already talking about tightening up. Why? The Fed is the IMF or the International Monetary Fund. And if the International Monetary Fund says they are doing global tightening, well, goddamn about you better understand that they're going to do tightening to everybody. Tight money policies tipped economies around the world into recession. International commerce contracted, meaning nobody's really doing commerce. What's happening right now? Commerce is contracting. And the international economy slowed. What are we doing now? Is it not slowing? A financial boom, however, continued. Stock market keeps running. Higher than higher rates. So the canary in the coal mine is always ask yourself one question. And that would be the same question that JP Morgan's grandfather asked. Who else can get into already 401k'd in, already Roth IRA'd in, already have their pensions in? So they're already in the market. So everybody over 60 who's been in some type of business or some type of has been somebody's employee and is on somebody's 401 or pension or whatever, they already in the market. Then you've got everybody in their 40s and 30s who have been in the market since the internet bubble, right? So they got into trading like I did. So I'm in the market. Then you have people below me, the Robinhood. They're in the market already. So who else is left that hasn't been beat the hell up by this time now? Because we aren't at the highs anymore. Let's look at this. Let's look at the S&P 500 chart. Right? over the last 5 years. Okay, so we're at the highest of the highest of the highest of the high. Let's go to Tesla. I want to see one thing on Tesla. Right? When did Elon sold? Right? And chart. Give me a chart for that. No. Let's see if Google can do this for me without me having to dig too deep. Can I see a chart? Do I get a chart? I don't get a chart. Do I see a chart? Do I get a chart? I don't get a chart. Okay. You suck. Tesla chart. There we go. Let's see if somebody popped it on here for us on TradingView. All right. Okay. I don't have it, but check it out. Elon sold here, or his brother sold here, and I think Elon sold here. Now, high, lower high, lower high, lower high, lower high. So as you're watching this, they are selling at these tops because they're going to buy at the next potential bottom. If the market gaps down, there's your gap right there, right? Isn't that on top of this right here? That's support. What was resistance, right here, resistance, can become support because you never tested this again. And the market will need a schnitzel. So what's the schnitzel going to do? The schnitzel will come in what? We're talking about the Fed is talking about Fed spring. What is the Fed thinking about doing in the spring? Raising inflation keeps pressure on the Fed to dial back stimulus faster. Rising inflation, excuse me. Why inflation is so high when it may ease. Inflation, falling unemployment prompted Powell's Fed pivot. Fed may have to end bond buying stimulus in early spring. Major shift questions about the Fed's credibility. Here's when the everything bubble will burst. So, see, spring, they're talking about easing. I want to see if they're going to Fed rates. Let's see. Rates increase. Falling employment. Fed members ready to raise interest rates if inflation continues to run high 2 weeks ago. Mortgage rate forecast of December, higher rates likely. In early spring. So all of this has not been 100% priced into the market yet. Because I don't believe the market understands where they sit at the top of these charts. Nobody's really looking at 1929 and trying to say, how do I pivot? Am I selling off stocks? I am buying out on my credit. Like I'm getting rid of credit. Because when interest rates go up and fluctuate, I won't be holding the bag on 22%, 24% interest rates as they try to recoup the losses that they get from all these people that are starting to default. Default rates aren't up, and that's the good thing. I was looking at the default numbers on the Fed reports. Like if you go to Fed and put DFA defaults. No, that's not what I'm looking. Let's go with credit. Right. Let's see. Delinquency rate on credit. So if you look at the delinquency rate is down. So delinquency rate was high. See, delinquency rate 2008 financial crisis went from being 4% to being up to 6% delinquency rates. We are now all the way down here. Like even during this, it was 4% before we had this little economic shutterbug, right? We dropped all the way down here because we haven't had these delinquencies. Why? Because we haven't had rates run up. So I'm just keeping an eye on certain statistical numbers. Let's go back to the charts one more time, just so I can kind of show you what I mean. Where if on the weekly, you can see we've crossed into the red. We've crossed into the red. We're already in the red starting back here. So up here was really, and this is November 8th, seems to be the top of the pop. And you can see we've crossed into the red down here, giving us another significant to the downside. And then we've got one more to the downside. Yes, we could potentially go up, but we are sitting at a blue line, weekly line, right above a purple line. This is our monthly line. So right now, and I want you to see this 200-day moving average. Right now, where's my 200-day? Here we go. Here's my 200-day moving average. We are right now above the 200-day moving average, over a monthly and above a weekly. Now, every time we breach a monthly line, like here's a monthly line here, we breach it, boom, we drop down to this monthly line. We then breach that monthly line, whoosh, we went all the way down. All the way now we've touched this monthly line. The next monthly line is down here at 29,000. So that is the next place that this can potentially go, especially if it breaches this monthly line and falls below the 200-day moving average. Because the minute we get, and I'm going to show you, when you don't believe that the 200-day moving average is scientifically sound, let me show you. We bounce off, we bounce off. We're staying above the 200. We collapse below the 200, and look what immediately happens. Whoosh, goodush, goosh, goodush, goosh. We come up, we touch it again. We can't. Boom, goodush, goosh. We hit this purple. We break all the way down to this purple, really, but we get back to this purple, and we float on it. Now, we're doing a convergence that's seemingly happening here, and while this green is here to pump, this green didn't do shite because a transformer, whatever, OptiBot virus, right? So I know right here is the end of it all. And the second week of December, which is when we slap over here, let me go back to 2017 so you see it one more time. This is the first week. This is the first week of December, second week of December, third week of December, crash. That's the 18th, week of the 18th. Third week of December, crash. I want you to go back and look and see. December dip. Where is that? Boom, December 10th. They actually had a pump on December 17th. But then it fell back down. January dips and it falls back down. So again, we have a January dip. Red right here. We have a January dip, that dark burgundy red. We have this is the 13th. This is really, it's supposed to be our pump. But on the week of the 20th, we could be seeing a smash on the market. Let me scroll out a little bit. So while we could have a pump this week on the 13th, second week, remember I told you this third week is danger zone. And that's why this red pump right here, Christmas, after that, basically is a dip. So this, Between here and here is a big significant dip. That means we only have 1 week left, at least according to what I know for the halvening cycle. So just be careful. I'm getting the hell out. I'm just getting out. It makes no sense for me to stay here. I got mine in here at 30. That's 10,000 more. Like, I mean, that's not $10,000, but I'm just saying there's a Bitcoin controlled the market for 10 grand. And right now, that is a profitability zone for me for a lot of the assets I've been holding that I bought here as well as down here. Here. Right around here for January, February, I got some. So again, I've been in this window the entire time. But what do I know, right? This is what I know. January's dip all the way to February, March. Dip all the way. This one only because it's happening. Dip all the way. So if I know this is happening, and I know we have a significant dip, I'm going to ride that dip down. That's going to put us back into this zone. That's why I'm going to cash here, dip down to this zone. But notice we don't have any information really here. We came up, we broke through, we never came back, we never played in this zone again. That is right here at this purple line, which is, again, the $19,000, $20,000 line. Do I think that we can go back down there? Why do I think that's possible? Because after the halvening cycle, when we had this huge spike, the market dipped, settled around March, still dipped around June. Then we have this November dip, and it fell off a deeper cliff to another set of levels. This is the level that will dip down from this potentially till spring. Will get us back down to here. But then with the November dip could put us back down to these $19,000, $20,000 levels so that we can flesh out this entire run up and actually touch back down here so that we know that we have our support before we can have another run up. So why wouldn't, if there's a potential that we're going to be talking about getting in at these prices down here, 19, 20,000, why wouldn't I sell up here to catch potentially that? Because again, the charts don't care how I feel about it. Even back here, we went up and it had to come all the way back down to touch here again. And even here, it touched it one more time before the next halvening cycle. It even came back down to touch it again. So you see, we broke through one touch, right here in this zone, one touch. We go back up, we came back and touched it one more time, 2 touches. The breakthrough, 2 touch, spring up, right? So we now look at that and say, well, we broke through, we came back, we touched. So we went up, we came, we touched, 1, we went up, we could potentially come back and touch one more time, and then that will be the next run up. That's what I'm looking at and why I'm making my position the way I'm making it. Looking at the day, we've crossed into negative territory and still floating high in it. We've crossed into negative territory here. I don't see the volume really, like the volume spikes just to keep it from breaking through these floors. But other than that, volume just tapers back off. Institutional investors want cheap shit. They want it to come back down. Retail investors have no capital right now to put in to keep it up. Hence, why when we look at our chart, when we're supposed to have runs, because of Transformer, we can't get those runs because the fear, uncertainty is keeping the market at bay. And until spring comes and they talk about what's going on with the economy and whether or not they're going to tighten or not, we can't make any for Toxic Hustle, can't make any financial decisions on that. I have to leave it be. And then what is our strategy then? Hardware. Services. What is your product? What is your service? What is your subscription? Right? Are you a musician? Do you make music? Okay, I'm going to show you royalties. Hold on. Let me close this out. Let me go over here. Give me 1 second. Let me come over here and open up my stats. And where is my... No, I don't need that. Stats. There it is. And let me log in. And then drag it over here so you can see it. There we go. All right. So, you all, again, I don't know who y'all are using. I know y'all get a whole bunch, y'all want to do a whole bunch of unlimited whatever the hell. And I'm telling you that unlimited whatever the hell ain't giving you crap. Why? Ask yourself a question. Do you have YouTube royalties? Does it cost you extra for your YouTube royalties? If the answer is yes, and you're paying more for YouTube royalties, then get the hell out of that damn company and put your damn merchandise someplace where you're actually earning. Why? I don't know what the hell KK Box is. I don't give a damn. It's generating something. YouTube content IDs. I'm generating something. YouTube content management public. I'm publishing. I'm earning something. UMA. Yandex. iTunes. Amazon. TikTok. Are you making TikTok money? I'm making TikTok money. Why the hell ain't you making TikTok money? CD Baby. I'm not making no, I don't get paid for them. I'm not an affiliate to them. I'm being just straight with y'all. There's a hustle to this game, and I'll share with you too. No, niggas gonna hate you for whatever you do. So now we're gonna get your cash on MOB. That's money over bristles because they breed envy. Now, rule 2 is that's a hard one. Watch for phonies. Keep your enemies close. Watch your homies. Watch these people that say they're making you money, dog. How are they making you money? For real, for real. Like legacy money. Like, can you leave this to your kids type beats? Yes, my PayPal account is attached that I can automatically send money, or this can be sent directly to a bank account, and that bank account can automatically have deposits that go into an investment account and earn interest for my kids. We're going to go through some hard-ish, y'all, and I'm giving you what's about to happen. I lived through 2008 as a grown-ass man. And I can tell you right now, that was no fun because I was demoralized. Residuals will help you to survive. So here, Tidal streams, Spotify sales, Tencent, China. That's China money. And they don't want you to do this. And I'm going to tell you what I'm going to do. And this is my hustle. I'm telling you, 2022, here's one of my hustles straight out. And this is why I'm building Toxic Hustle the way I'm building it, is because I'm building it to be a way for me to catalog my assets so I know where all of my music is, where am I earning, and then when I create playlists, how are those playlists helping my music get pushed? And I'm not talking about no SM Zeus type beats. I'm talking about how do we create legitimate Spotify playlists that you push or I push through multiple means of just integrating the music into other products and services. Hey, I'm streaming. I'm going to play this music. That music gets picked up by YouTube. You get paid. I can put in my own music in there. I play it on YouTube. I'll get paid. If it goes on TikTok and somebody streams it on TikTok, it gets picked up for something, I'll get paid. My goal is now I just need to create more instances of me having content that people may want. So what do? You put it out for free. At this point, I could sit there, upload it to CD Baby, get it onto Spotify, get it. It's going to be put onto TikTok. It goes everywhere. One time, pay it one time. That's it. I don't got to pay it no more. And then every new place, every new that they come up with, they keep adding the new to me. You pay one time. They'll get their money out of the royalties. That's what they're supposed to do. That's what a royalty agency is supposed to do. And this has nothing to do with being on BMI or ASCAP. You can do those, but they don't make me no money. I've been an ASCAP member for years now. Since 1999 or 2000 or some shit like that. And I ain't seen no checks. I've seen more checks with CD Baby though. A lot. And I'm going to see a lot more at the way I'm going to be distributing content once this new site starts marketing my products. But understand, this is your royalties. These royalties add up. And if you look at it, it's no different than what you're thinking about with blockchain. You've just got to look at this hustle a whole different one. So this is one of the ways I'm going to be generating. Of course, I've already put my miner up, which I talk about in the Discord. Where's the... There we go. Hold on. Oh, really? Really, computer? This is what we doing? Hold on one second. Thing is acting like a monkey nut. There we go. Give me that. There we are. So if you scroll down... Oh, that was the... Okay, he got it for me. Thank you, sir. There we go. So we have this up. This is the helium miner that we have up at the office right now, at the kitchen. So we're already mining. I'm just waiting to see how that's going to generate or if I set it up properly. Thing is, y'all, every single portion of how I'm going to be generating like services, subscriptions, clients, looking for client. I'll be working with clients, getting websites up for clients, getting designs done for clients. Of course, getting into the NFT market, designing graphics for other people that want NFTs. Like, it doesn't mean you have to be the NFT maker. Remember, picks and shovels. So if you know how to do graphics, then you can design the drop for a person and then charge them for the drop, so for the graphics. So like I can sit there and say, okay, well, I'll design, say, 10,000 graphics for your NFTs, and I'll charge you, say, $2,000 for it. Right? And then I just do I make the work and I do the generation for them. And then depending on how much graphics they want or how many they're trying to print out will determine, how much it costs. Or if I'm designing websites for blockchain companies or for crypto companies, again, picks and shovels. Are you video editing services? So like if you can do things and do work, you can take your time and turn it into money. That is what you do when you're dealing with what we're dealing with this recession, where jobs ain't gonna be there. Like hunting ground. I'm gonna show you the where I'm gonna be working. This is where I'm gonna be getting most of my work done. I'm gonna go to Fiverr and I'm gonna get work done. Yeah, I'd have to sign in and all that shit, something like that. But yeah, so literally digital marketing, growing brand. Like I'll be going in here looking at what people are offering as services, seeing where I can automate some of those services to be able to outposition some of these people that are still working manual. Where is I'm going to be researching to find where there's actual opportunities to get clientele. What are clients actually looking for? What kind of services can I offer to them? And how can I do that in an automated way so that I can keep costs down? That doesn't take me having to do anything. Or what subscriptions can you offer? Do you have a subscription offering? I'm going to be doing a newsletter. That newsletter is going to be based off of how we're trading or some of the tools we're using to look at some of the assets that we're holding. When is a good time to get in? What's going on with some economic measures? Being able to, what I'm doing over here. If I come over here, these signals, what if I could have a signal that launched that tells, hey, that we're in a selling zone? What if I had another signal down here that was saying we're heading towards a buy zone? And those alerts could come out. That's another thing I want to have the site do. So again, there's a lot that needs to be done, and that's what I'm working on. But those are the things you've got to look at for yourselves as well. Like, what is your product? What is your service? What is your subscription? Through this transition, that's all we got. That's it. You can say, where's your job? But I'm telling you right now, how I got my jobs through the last recession was I worked for me. I put product up. I put a gallery up of the stuff that I was doing for my own stuff underneath whatever company I was working on for me. Those things ended up on my resume. And then I was able to utilize those things, the proof that I could do the work, as my entry point into any corporation via the temp market, Indeed.com. So you can use the temp market or Indeed to get yourself clientele. You can use Fiverr to give you that people can pay you for you to build out your portfolio. Right? You can charge lower just to be able to get your portfolio together. Or you can just create and craft a portfolio based off of you doing work for yourself. Right? Then that portfolio can be put on your resume. And then that resume can lead you to a job. And then, especially if you're working you can work remotely, that keeps you from catching Pokemon or a Transformer or whatever, right? So keep that on your radar right now, that the market is shaky. We're already in red zones, as you can see down here on the daily. We're in red zones in the weekly. And we're in serious red zone. Well, we're in green zone on the monthly, but it's converging. And as I've told you, this 200-day moving average we're getting, like, look, we are getting ready to break. Like, look how close. We're getting ready to break a purple and the orange, y'all. We break that, we fall to 45. We break that, we fall to 43. These are the other monthly lines we can bounce to. 41 is another monthly line we can break to. But again, if we break through, I feel like if I go back to my other chart, on the weekly, I'll have to, hold on, let me look at monthly here. Do we have more monthly numbers? Let's see. We may have some more monthly numbers, and that might support us a little bit more. Give me a second. Let me see. I've got a monthly there, but I also have a monthly here. This is also a monthly, that right there. But I'm going to go with these right here, just because some bounce points, significant monthlies. So now if we come back to our weekly, you can see we're not hitting that yet. And then if we go to our daily, which will give us our 200-day moving average, you can see we're bouncing right off that 200. But we are in a negative here. We are negative here. And we're getting ready to, looks like we're going to be poking positive. But if we jump down to the 4 hour, we're in a descending on the green. If we go to the 2 hour, even more descending. on the green. We go to the 1 hour. We've actually crossed into red territory here, crossing into red territory there. So now we're getting ready to, again, reject where we're heading here. We're crossing, reject it. We're already under this 200-day moving average, and it's showing we're rejecting going above it. There's not enough volume, strength to push it above. Nobody cares about this 200-day moving average, which is going to slide us down to the 45 zone. If we don't get above this thing. So like I said, at the 1 hour, we're already below it. The 2 hour, we're already below it. The 3 hour, we're already below it. The 4 hour, excuse me. The 12 hour, we are below it. We see what happens when we broke through. Bang. Crash. Daily, we are above it on the daily. And it's fighting to try to keep above, but we are in the red here. We are in the red there. And we could, if it keeps going what we saw in the current 1 hour, we're in negative territory. If that 2 hour, which is still positive, but we could encroach in negative, and we're still positive. If it keeps up, but I don't see volume, like 4 hour, still positive, but I don't see volume. A little bit of a poke right there, but we go to the 12 hour. Yeah. Under the 200, dropping like a stone. Right after we broke it, we touched it, we bounced off, but we are fighting to stay above that line on the day. So while we are positive right now, again, if we go to the week is showing negative when it would have been positive. And this, which is supposed to be positive, like we're already, see, we've crossed into negative territory right here on the monthly. On the weekly. We've already crossed into negative. We're already in negative back here, which is causing this drop. And now these other signals are starting to tell us potentially we're going to cross negative. I don't want to play this game. So again, I'll be out today. I'm thinking I'm going to go ahead and cash. I'm going to look for a buy back in slightly at the, this could be a support line, so 39. And then there'll be this zone. And we'll see if we stay there. I'll buy a little. But I'll be looking to see whether or not we hit this, if we go back and test this again. 28. I don't believe we're going to come back all the way to 19. But as I said, if you look at the chart, that was our last real entry point, and we never really came back to touch it and test it. We've never tested it again. We've just kept going up. One thing that this does is it goes up, it tests all the way back down. And it tested all the way back down here. That was resistance. What was support here? You look at that line, was right here. Same thing here. Just watch the dotted line. And just follow the dotted line all the way across over here. This is support. And we bounce right off of support. All the way over here. So we touched it. We broke through. We have not come back down. When would be the best opportunity for it to come down? Would it not come down during its seasonal December? Oops, Control Z. Oops, hold on. There we go. It's seasonal December, January dip. That would be the best time for it to come back here and crash. And as you've seen, short of this one time, January seasonally dips. So just get ready, y'all. There is a dip of brewing. Then there's going to be a January